Hey everybody, Marc Geredes back again from Sunday with this week's installment of Market Minute. Okay, so last week we talked about personal savings as a percentage of disposable income and that US consumers are the only consumers worldwide who are spending more and saving less than ever before. In a similar vein, I want to talk about consumer debt levels because it's another data point that suggests that US consumers are actually in a pretty tough spot right now. Let me show you what I mean. So what you see in front of you right now is the total credit card debt in the United States from 2018 through the end of 2023. And just like we did last week, we're going to look at this in terms of the pre-pandemic period, during the pandemic, and then the post-pandemic period, and kind of see what was going on with consumer credit debt during each of those periods of time. So starting with the pre-pandemic period of 2018, almost up to the beginning of 2020, you can see that consumer credit card debt was rising rapidly. What's interesting to note here is that consumers did actually start to reduce spending and pay down their debt levels just prior to the beginning of 2020. Then the pandemic period. In this case, we're talking about really just the year of 2020 itself. As you can see here by the green arrow, that consumer credit card debt actually dropped fairly substantially, which is consistent with what was going on during that period. And we saw with respect to personal savings during the pandemic, as that increased, what you're seeing here is the effect of that as well, where people are paying down their credit card debt in a real meaningful way. Then the post-pandemic period, and this is really striking. So even prior to the end of 2021, which people consider as the true end of the pandemic, credit card debt started increasing again, actually ballooning from $775 billion all the way up to $1.13 trillion. And this is literally over just a 3-year period of time. Even more concerning than that total debt burden is that credit card balances actually increased by $50 billion in the fourth quarter of 2023 alone. Not surprisingly, credit card delinquencies surged more than 50% over the course of 2023, which you can imagine was caused by just the rates that are being charged on credit cards these days in excess of 20% in many cases. So the consumers are actually buried in credit card debt. And that combined with the amount of debt being so incredibly high, consumers are starting to really, really struggle. So to wrap it up, with personal savings at historic lows and consumer debt at historic highs, something's got to give. But as we all know, bad habits are really hard to break. It's not a matter of if the consumer is going to stop spending, but a matter really of when they're going to stop spending, which is going to cause the economy to slow down quite a bit, which ultimately will cause interest rates to go down. All right, so that's all I have for this week. Next week, we'll turn our attention to U.S. housing inventory and what we think that means for home prices in 2024. Have a great week, everybody. Take care.